Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's panelists are Mark Soderberg, our Senior Ag Market Specialist, and JP Steiner, our Associate Economist. Starting with the grains market this morning, Mark, what do you make of President Trump's urge to China to quadruple their U.S. soybean purchases?
Well, thanks, Jeannie. Well, to me, it's a little bit of a head scratcher, particularly the part where President Trump claims that China is worried about their shortage of soybeans. China's imports to date this year are a record high, with roughly 75% of those soybeans coming from Brazil. They have inked purchases from our South American competitor now dating out to October or November of this year, a time usually dominated by U.S. Beans into China. The president went on to state that U.S. farmers produce the most robust soybeans in the world, and calling on China to quadruple their purchases of U.S. beans, while adding that rapid service will be provided. Thank you, President Yi. Where exactly President Trump gets a quadruple figure from, your guess is as good as mine. Right now, China has exactly 0 bushels on the books for the 25-26 marketing year from the U.S. So 4 times 0 is still 0. A year ago, China just started buying U.S. beans, having roughly about 20 million bushels booked. As of early August, for all of 24-25, China has taken in 840 million bushels of U.S. soybeans. That's the lowest figure since the 2019-20 marketing year, when we were having our first trade war with China. So if you times that by 4, that comes out to 3.35 billion bushels. That's almost 80% of this year's crop. So that's not going to happen. I think this is likely just a ploy by the president to persuade China to get a trade deal done that includes shifting some of their ag purchases to the U.S. and away from Brazil. The current trade truce with China ends tomorrow, same day as the USDA production and WSDA data. So I'd expect some volatility ahead. I see today's trade as likely some short covering ahead of tomorrow's data, as speculative traders have built up the largest short position now in soybeans since late last year.
The plot thickens. Next question. What are your expectations for tomorrow's USDA reports?
Well, I think like everybody else, I look for higher corn and soybean production figures. In corn, I'm at just over 16 billion, 50 million bushels. That's up about 345 from the USDA forecast in July. My average yield works out to 185 bushels an acre, up from the USDA's already record at 181. I see old crop ending stocks slipping 20 million bushels to 1.32 billion on slightly higher exports, partially offset from lower domestic usage. I see new crop stocks surging to nearly 2 billion because of the higher production. I am just above the average trade guess in both production and new crop ending stocks. On the soybean side, I've got production. I see old crop ending stocks slipping 10 million to 340 million on higher crush. My production forecast is at 4.385 billion. That's up 50 million from July, and that's about 20 million bushels above the average guess. I've got new crop stocks growing to 355 million bushels, pretty much in line with the average trade guess. On wheat, I'm at the low end of the range of guesses. I'm just under 1.9 billion for the all wheat crop. That's down 34 million from July. My winter wheat forecast at 1.325 billion. That's at the very low end of the range of guesses, down 20 million from the average guess. I've got ending stocks at 858. That's about 25 below the average guess. Globally, the only biggest changes I see is a 3 million metric ton increase in Brazilian corn production up to 135 million metric tons, and a 1 million metric ton increase on their beans, that up to 170 million metric tons.
All right, thanks, Mark. Moving over to financials. JP, what events are on the economic calendar this week?
Yeah, this week has several events on the calendar which will impact what the markets do. Tomorrow, Consumer Price Index inflation data for July will be the key focus for investors this week, especially following the weaker than expected jobs data 2 weeks ago that boosted expectations for a Fed rate cut in September. Thursday, we get Producer Price Index inflation data, that will offer further insight into pipeline inflation. Recent PPI data has shown that producers have been dealing with higher prices, and recently the US ISM Services Purchasing Managers Index data showed a significant rise in the prices paid sub-index, indicating that tariffs have directly led to higher costs for producers. The survey also detailed that businesses were planning on passing those costs on to consumers, and that tariffs remain the number one headwind for businesses. So I am curious to see how those responses from businesses will have played out in the PPI data and the extent to which these responses will have come to fruition. Producer prices are expected to have risen 0.2% in July. Also on Thursday, we get weekly initial jobless claims data. Last week, we saw an uptick with 226,000 new claims. That snapped a 4-week streak of falling claims. Jobless claims will continue to stay in the spotlight as eyes stay peeled on the health of the labor market, where a deterioration in labor market conditions could send the Fed to cut rates further than expected. The most recent jobs data and revisions has sent shockwaves across markets about really the reality of the labor market and increases speculation that the Fed will cut rates at its September meeting. Lastly, to round up the week, we have retail sales and consumer sentiment data on Friday. That should give us a relatively up-to-date picture on how the consumer has been holding up in somewhat of a turbulent time for them and what we can expect in the future.
Thanks, JP. For our last question, as you mentioned earlier, what should we watch for in Tuesday's CPI data?
Yeah, so this week's inflation data for the U.S. is especially important because it could shape expectations for Fed policy and influence. With recent weak jobs data increasing the likelihood of a rate cut in September, investors are now watching to see if inflation, particularly from tariffs, is accelerating. As I mentioned earlier, the ISM Services PMI data showed a significant rise in the prices paid sub-index. That reminded markets that inflation is still a force to be reckoned with. Markets will be watching to see the extent to which tariffs are affecting prices after the previous data in June showed early signs of larger increases in goods prices. Core consumer prices are expected to have risen 0.3% in July, and economists are expecting prices to continue to increase in the fall. That's where I think the most noticeable and significant effects from tariffs will be felt on prices. If price pressures are stronger than expected, it could complicate the Fed's decision-making, potentially canceling rates or altering the pace of easing. In my opinion, any reading that is above a 0.4% growth in core prices will keep the Fed from cutting rates in September, barring any disastrous effects in the labor market, despite the weak report we saw last week. Now, I say this given that only 2 officials voted for a rate cut at its latest meeting, showing that most governors are more concerned about the inflation picture in the economy than they are concerned about the health of the labor market. Now, it is a little early to make a call like that, given that we do have another labor report due at the end of August, which will help give the Fed some better data to make a decision with. So take that prediction with a bit of a grain of salt. But in short, this data will help clarify whether the Fed can prioritize growth or remain cautious about inflation.
All right, thank you both. Remember, the views and opinions expressed here today on this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.